Good morning, ladies and gentlemen, and you are welcome. Today, we are going to continue our discussions. We are going to look at the chapter 2 of our syllabus, and that looks at the IASB conceptual framework. The IASB's conceptual framework. Right. Now, students are expected at the end of this chapter to have an understanding and appreciation of the following. One, a conceptual framework for financial reporting. Two, the IASB conceptual framework. Three, the qualitative characteristics of useful financial information. Four, the elements of financial statements. The elements of financial statements. So at the end of this section or chapter, students must demonstrate understanding in these four key areas: a conceptual framework for financial reporting, the IASB conceptual framework, qualitative characteristics of useful financial information, and the element of financial statements. Great. So now let's look at the section 1, which is a conceptual framework for financial reporting. A conceptual framework for financial reporting. Now, we are going to look at the meaning of GAAP, that is generally accepted accounting principles. I know at the introductory stage, we spoke briefly about it. Now we're going to look at it in detail. What is it, among other things? Then the meaning of a conceptual framework. The meaning of a conceptual framework. And 3, we will look at the purpose of a conceptual framework. Great. So the meaning of GAAP. The meaning of GAAP. Now, when we talk about GAAP, it's simply an acronym for generally accepted accounting principles. GAAP. It simply means generally accepted accounting principles. Now, it refers to all the concepts, principles, conventions, laws, rules, and regulations that are used to prepare and present financial statements. Okay, so it means that in accounting, okay, we don't just stand up and prepare financial statements. The financial statements that we prepare, are grounded on certain principles, on certain rules, on certain concepts, on certain regulations. Okay, good. Hence the name generally accepted accounting principles. Good. Now, generally accepted accounting principles vary from country to country because each country has its own legal and regulatory system. For example, there is a US GAAP, there is a EU GAAP, there is a UK GAAP, and there's Ghana GAAP, and so on. Okay, so basically when we talk about GAAP, okay, that gives us the authority, okay, to prepare financial statements the way we prepare them. Okay, it gives us the ways and means in which, okay, the element of financial statements should be what? Recorded. Okay, good. So Ghana, in common with many other countries, has adopted International Financial Reporting Standards, that's IFRS, as its own GAAP. So if you say that a GAAP, or if you hear of a GAAP, basically we are looking at the set of concepts, rules, principles that an organization uses in preparing its financial statements. Now, this GAAP is not the same for all countries. It differs from one country to the other. Okay, Good. As I said, there are those laws and principles and concepts that gives us the authority, okay, to do things or to record financial transactions, to recognize or to measure financial transactions the way we measure them or the way we record them, okay, in the books of an entity. Okay, great. Now, as I indicated, there is a US GAAP, there is a EU GAAP, there is a UK GAAP, and Ghana has its own what GAAP. Okay, but in Ghana, our GAAP, that is our generally accepted accounting principles, which underpins the preparation of financial statement, is the International Financial Reporting Standards. Okay, the International Financial Reporting Standards were adopted by Ghana in sometime 2007, 2009 as our GAAP, okay, as our generally accepted accounting principle. Okay, they are the rules, they are the laws, they are the conventions that we have to follow if you want to prepare financial statements in Ghana. Okay, great. The word IFRS encapsulates both IFRSs and IASs and all associated interpretation and guidelines. So when we talk about IFRS, which is International Financial Reporting Standards, it is in two sections. We have IFRSs and we have IASs. Okay, IAS was International Accounting Standards. Okay, that is what the IFRS started with. Okay, so we have an IAS, International Accounting Standard. Now, they become IFRSs when they go through a series of changes, updates, upgrades, okay, and then they become IFRS. Okay, however, when you hear of IFRS, it means that we have both the IFRS and the IAS. Okay, great. So we'll be looking at some of them in the course of our study. Okay, and you do a chunk of them in level 2 in financial reporting. So these standards are the principles, the bases, the conventions, the laws, the rules, which are applied in the preparation of financial statements. Okay, good. So we look at the meaning of a conceptual framework. What is the meaning of a conceptual framework as defined by the International Accounting Standards Board, IASB? Now, this framework was issued by the International Accounting Standards Board to outline and explain the concepts underlying the preparation and presentation of financial statement for external users. Okay, this framework, that's the conceptual framework, was issued by the International Accounting Standards to outline and explain the concepts underlying the preparation and presentation of financial statement for external users. So now, when we talk about conceptual framework, a conceptual framework, it refers to a system of concepts, principles that underpin the preparation and presentation of financial statements. These concepts and principles should be consistent with one another. Okay? Now, a complete new conceptual framework was published by IASB in March 2018, and it's called the Conceptual Framework for Financial Reporting. So the initial conceptual framework that was in use has been updated, and the most current one was issued in March 2018, and it is termed as the Conceptual Framework for Financial Reporting. This new conceptual framework was developed on a chapter-by-chapter basis. It is made up of 8 chapters, as indicated below. So, as we said, when we talk about conceptual framework, we are saying that we are looking at the set of principles and concepts that underpin the preparation of financial statements. And again, I've mentioned that the most current conceptual framework was issued in March 2018, Okay, and it was termed as the conceptual framework for financial reporting. Okay, and it is made up of how many chapters? 8 chapters. Okay, so let's look at these chapters. One, we have the objective of general purpose financial reporting. The objective of general purpose financial reporting is covered under chapter 1 of the conceptual framework. Chapter 2 talks about the qualitative characteristics of useful financial information. The qualitative characteristics of useful financial information. Chapter 3 talks about financial statements and the reporting entity. Chapter 3 talks about the financial statements and the reporting entity. Chapter 4 talks about the elements of financial statements. The elements of financial statements. Chapter 5 talks about recognition and derecognition. Recognition and derecognition. Chapter 6 talks about measurements. Chapter 6 talks about measurements. Chapter 7 talks about presentation and disclosures. And chapter 8 talks about concept of capital and capital maintenance. Chapter 8 talks about the concept of capital and capital maintenance. Now, note well, only chapter 2 and 4 are specifically included in our syllabus. Only chapter 2, which is the qualitative characteristics of useful financial information, and chapter 4, the element of financial statement. Those are the units or chapters that are to be considered in paper 1.1, financial accounting. It should be noted that this framework is not an accounting standard, and nothing in the framework overrides a specific accounting standard. So when we talk about the conceptual framework, we are saying that the conceptual framework is not an accounting standard, and nothing in that framework overrides a specific accounting standard. Note it. It is just a framework within which, financial statements, should be prepared. They give us the framework gives us the set of concept, principles, laws, rules which we should follow in the preparation of financial statements. Okay, great, but it does not override an accounting standard. Good. So let's now look at the purpose of conceptual framework. The purpose of conceptual framework. Now, one, a conceptual framework assists the IASB in the development of future IFRSs and its review of existing IFRSs. Okay, the conceptual framework assists the International Accounting Standards Board in the development of future IFRSs and its review of existing IFRSs. Okay, because they are the set of laws, rules, principles which underpins the preparation of financial statements. Okay, the IASB tends to continually review these principles, laws, and look at the effective way or the most convenient way by which standards could be developed to make life better. Okay, great. So it is just there, or the framework helps the IASB in its review, and development of new standards. Because don't forget that we said that they are the laws, principles, concepts which underpins the preparation of financial statement. So at one point or the other, the IASB will be looking at, the old way of doing things, is it still helping us, or we should look at a more advanced or a more a practical approach to doing things. Okay, great. So it assists them in the development of future IFRSs and its review of existing IFRSs. Good. 2, it assists preparers of financial statements in applying IFRS and in dealing with topics that are yet to form the subject of an IFRS. Okay, the conceptual framework assists preparers of financial statements in applying IFRS and in dealing with topics that are yet to form the subject of an IFRS. Yes, so there are times there are certain controversial issues, okay, in accounting, that a particular situation might not be covered by a particular standard, okay, but because there is a conceptual framework which outlines the general principles, the concept, the basis for preparation of financial statement, okay, even when there is no accounting standard which directs us as to how to treat, as to how to recognize an item based on the general principles and concepts, okay, we find a way around those transactions, okay, good. 3, assess the IASB by providing a basis for reducing the number of alternative accounting treatments. Assess the IASB by providing a basis for reducing the number of the number of alternative accounting treatments. Okay, so there are times where we have various alternatives by which a particular accounting transaction could be treated. Okay, however, because of the conceptual framework, it assists the IASB in having to reduce. Okay, so for example, when you look at IAS 16, okay, we have various ways, okay, by which we can account for PPE. Okay, you can say that either you are going by the cost model or the revaluation model. Okay, good. So in accounting, this concept or this framework is very important because it is the basis for new developments. Okay, good. So it helps the IASB, that's the International Accounting Standards Board, in its work. Okay, especially when it comes to having to look at alternative treatment of accounting transaction. Okay, great. So it must make sure that even if you are developing accounting standards and others, the reference is being made to the conceptual framework so that the standard is consistent with the rules, the principles that underpins the preparation of financial statements. Okay, great. Again, it assists national standard setting bodies in developing national standards. The conceptual framework assists national standard setting bodies in developing national standards. So Ghana used to have the Ghana accounting standards, and those standards were developed by reference to the conceptual framework. But what is important now is that now we have adopted the IFRS. Okay, so that becomes our financial reporting framework. Okay, great. And these standards were also developed, or they were put together with reference to the conceptual framework. Good. Now, the framework strengthens the credibility of financial reporting and the accounting profession in general. The framework strengthens the credibility of financial reporting and the accounting profession in general. Yes, because whatever that we do in accounting can be referenced to certain principles and laws. Okay, it means that we cannot just do things in abeyance. We cannot do things the way we want without reference to any set of laws, rules, or principles. Okay, because there are laid down principles, concepts, among other things, which should guide us. Okay, it makes sure that at any point in time, it means that at any point in time, the financial statements that are turned out are transparent, are credible, and one can easily understand it. Okay, great. The next purpose is that it assists auditors in forming an opinion as to whether the financial statements comply with what IFRS. Okay, great. So as auditors are to give independent view as to the financial statement prepared by an entity as to whether it complies with what the International Financial Reporting Standards, comply with laws and regulations, among other things. Okay, so as auditors, they are also trained accountants, or they are qualified accountants. who understand the basic principles that underpin preparation of financial statements. So, in as much as they are giving their view, okay, or expressing their opinion as to the truth and fairness of the financial statement prepared, it means that they must have a good understanding of the what of the IFRS, so that when the financial statement is put before them to audit, they will be able to see through to ensure that, okay, every single item in the financial statement has been treated in line with the International Financial Reporting Standard, therefore represent a true and fair position of the entity's financial position, performance, and cash flows for the year ended. Okay, good. So it assists auditors in forming an opinion as to whether the financial statement comply with IFRS. And finally, assist users of financial statements in interpreting the information contained in financial statements prepared in conformity with IFRS. Great. So now the IASB conceptual framework. Now let's look at the IASB conceptual framework. Now, at the end of this session, students are expected, one, to demonstrate an understanding in the underlying assumption in the preparation of financial statements. Two, to know the various uses of financial information and their information needs. And three, to know the object or the objective of general purpose financial statements. To know the objective of general purpose financial statements. Good. So now let's look at the underlying assumptions. The underlying assumptions. Now, this refers to the basis for the preparation of financial statements. So when we talk about underlying assumptions, we are looking at the basis for the preparation of financial statements. The fundamental assumptions are: one, going concern. Now, the financial statements are normally prepared on the assumption that an entity is a going concern and will continue in operation for the foreseeable future. Hence, it is assumed that the entity has neither nor the need to liquidate or curtail materially the scale of its operations. This concept assumes that when preparing a normal set of accounts, the business will continue to operate in approximately the same manner for the foreseeable future, at least the next 12 months. Okay, so when you're preparing financial statements, the assumption is that the business will continue to exist into the foreseeable future. And when we are looking at going concern, assuming I'm in 2020 now, if I'm preparing 2020 financial statements, okay, I have the belief that in 2021, the company will still be in existence. Okay, good. So we look at going concern by reference to the next accounting period, which is the next 12 months. It could be more. Okay, good. But the least that you can look at is within the next 12 months, will the company be in existence? If you do your assessment and you don't know, and you come to the conclusion that in the next year the company will be in existence, that means that you need to prepare your financial statement on what? On a going concern basis. I hope it's understood. So the going concern assumption is seen as one of the fundamental assumptions that underlines the preparation of financial statement, in that a business entity has no intention to either cease operation or to curtail materially its scale of operations. Okay, good. So the going concern assumption is one of the underlying or fundamental assumptions on which financial statements are prepared. So for those of us who are business students or were business students in SS, you can see that when transactions are recorded in the respective day books, okay, it is being posted to the ledger. The ledger must be balanced off and a trial balance extracted. So you can see that when the ledger is being closed off or being balanced, we have the introduction of this balance carry down balance portfolio. Okay, these are indications of continuity, that the business has no intention to cease. That's why I say balance brought forward. it's an indication that we are going to continue. Do you get the point? Great. All right. The next assumption is the accrual basis. The accrual basis. Don't forget that we have already we spoke about this in our first chapter, chapter 1. Okay, good. But what is it? Now, accrual basis means that the effect of transactions and other events are recognized when they occur and not as cash or its equivalent is received or paid. They are recorded in the accounting records and reported in the financial statement of periods to which they relate. So the accrual basis is of the view that business transactions, events should be recognized when they occur, not when cash is or its equivalent is received or paid. So if I sell goods on credit to a customer, I have not received cash. But since the transaction has occurred, I need to record it. I hope you get me. Now, there is exchange of goods. So once I've sold goods, my goods are going out. Okay, so I need to record that I've made a sales or a sales transaction has occurred. So I need to record it. Okay, good. And in accounting, we say that every transaction should have two effects. Okay, a debit and a credit. Okay, so once I've parted ways with goods, okay, and the goods were sold to a customer, okay, I need to record that sales has been made. Okay, good. So if I record the sales portion, then how do I record the other portion? Because every transaction should have two effects. Okay, good. Now, because the sales that I made was not for cash, I cannot say that I'm getting cash. Okay, now when I sell on credit, I create what is called debtors. Okay, I create customers in layman's view, because that customer did not pay me. And once that person didn't pay me, he becomes indebted to me. Hence the name debtors. Or it becomes a receivable. Okay, so you see trade receivable, trade debtors, or simply debtors. Do you get the point? Great. So now, we shouldn't wait till funds have been received or cash has been paid before we record accounting transaction. That is not the premise of accruals. Accruals is of the view that once a transaction occurs, okay, that transaction needs to be recorded. Okay, we don't wait till we receive cash or we pay cash. Great. NB, note the accrual basis is not an underlying assumption, but chapter 1 of the conceptual framework makes it clear that financial statements should be prepared on accrual basis. So we are to note that accrual is not an underlying assumption, but chapter 1 of the conceptual framework makes it clear that financial statements should be prepared on accrual basis. Don't forget that we spoke about accrual basis as a basis of accounting, And don't forget we had the cash basis, accrual basis, and breakup basis. So when we talk about underlying assumption, okay, accrual basis is not one. The fundamental assumption is the going concern assumption. I hope you are together. Good. The users and their information needs. So in chapter 1, we spoke about the various users. Okay, we spoke about what lenders, we spoke about what shareholders, we spoke about what lenders and lenders. We spoke about trade creditors. Okay, we talked about the government. We spoke about the public. We spoke about employees. We spoke about managers. Okay, good. And we looked at the 3 of them. Okay, and I tasked you to look at the information needs of the other users. Right. Good. So the conceptual framework, however, identifies existing and potential investors, lenders, and other creditors as primary users for whom general purpose financial statements are directed. Okay. So you can refer to chapter 1 for the users and their information needs. Okay. And we also spoke about the objective of general purpose financial statement. Now, the objective of general purpose financial reporting forms the foundation of the conceptual framework. Other aspects of the conceptual framework follow logically from the objective. Okay, follow logically from the objective. So we also spoke about the objective of general purpose financial statement, and we did mention that there is the need for financial reporting, okay, because it provides vital information on an entity's financial position, financial performance, and changes in financial position, which helps users of accounting information to make useful decisions. Okay, good. So you can still make reference to page 13 of chapter 1, and you get to know the objective of general purpose financial statement. Good. Now, let's now look at the qualitative characteristics of useful financial information. Useful financial information. The qualitative characteristics of useful financial information. Now, at the end of this session, students are expected, one, to know the fundamental qualitative characteristics of financial information. Students should know the fundamental qualitative characteristics of financial information. Two, the enhancing qualitative characteristics of financial information. And finally, to know the cost constraints on useful information. To know the cost constraints of useful information. Great. So, to the qualitative characteristics of useful information. Okay. Now, the qualitative characteristics of useful information is covered under chapter 2 of the IASB conceptual framework. The financial accounting information must have certain characteristics in order for it to be useful for decision making. The framework identifies two basic characteristics of a useful financial information. Okay, the characteristics of useful financial information. Good. According to the framework, there are two basic characteristics. We have one, the fundamental qualitative characteristics, and two, the enhancing qualitative characteristics. So the characteristics of useful financial information is two: fundamental qualitative characteristics and the enhancing qualitative characteristics. Good. Now, the fundamental qualitative characteristics of financial information. Okay, let's look at the fundamental qualitative characteristics of financial information. Now, they are A, relevance. Relevance. The financial information, okay, must be relevant. Again, faithful representation. Faithful representation. So the fundamental qualitative characteristics of financial information are relevance and faithful representation. What do they mean? Or what does it mean for a financial statement to be relevant? What does it mean for a financial statement to represent faithfully, okay, the financial performance of an entity? Great. Then the qualitative characteristics that enhance the usefulness of financial information that is relevant and a faithful representation are. So this is what is called the enhancing qualitative characteristics of financial information. Okay, we talk about comparability, we talk about verifiability, we talk about timeliness, and we talk about understandability. Note, for information to be useful, it must be relevant and faithful represent what it purports to represent. The usefulness of financial information is enhanced if it is comparable, if it is verifiable, if it is timely, and if it is understandable. Information must be both relevant and faithfully represent if it is to be useful. Financial information must be both relevant and faithfully represented if it is to be useful. The enhancing characteristics of comparability, verifiability, timeliness, and understandability cannot make information useful if that information is not relevant or not faithfully represented. Okay, so basically, there are two fundamental characteristics of financial information, okay, which is relevance and faithful representation. Okay, good. Now, in the absence of the financial information being relevant and faithfully representing what it's purposed to represent, okay, that information cannot be comparable, it cannot be verifiable, it cannot be timely, and it cannot be understand. We cannot understand it. Okay, good. So let's look at what is meant by relevance. What is meant by financial information to be relevant? Okay, good. Now, information is relevant if it has both predictive and confirmatory value. And information is said to be relevant if it has both predictive and confirmatory value. Now, it has a predictive value if it helps users to predict what might happen in the future. We say that information is relevant if it has both predictive and confirmatory value. And it has predictive value if it helps users to predict what might happen in the future. Okay, it has confirmatory value if it helps users to confirm the assessments and predictions they have made in the past. Okay, great. So when we say information is relevant, it means that that information must have predictive and confirmatory value. Okay, good. So when you look at an entity's financial statement, okay, and you review and assess the financial statement, okay, and if indeed it's been prepared, okay, by following the conceptual framework, okay, all right, what we are saying that you must see this quality of the financial information being what relevant, and that it should have a predictive and a confirmatory what value. Okay, predictive in that we should be able to predict or tell what will happen in the future by looking at the financial statement, and it must also have a confirmatory value, which helps users to confirm assessments and predictions they have made in the past. Okay, good. Now, the relevance of an information is affected by its materiality. The relevance of an information is affected by its materiality. Now, information is material if omitting, misstating, obscuring it could reasonably be expected to influence decisions of the primary users based on financial statements. Okay, so basically, we say an item is material, okay, when its omission, okay, misstatement could reasonably be expected to what influence the decisions taken by the users of financial information. What do I mean? If you have the account of a bank, an account of, say, a savings and loan or a microfinance somewhere, okay, what will be material to the bank maybe immaterial to the bank, maybe material to the savings and loan or microfinance. So take GCB for example, Ghana GCB Bank. If GCB should maybe have its financial statement misstated by an amount of, say, 100,000 Ghana cedis, looking at the millions of cedis that GCB Bank controls, okay, if GCB should have its financial statement misstated by, say, 100,000 Ghana cedis, it will be nothing to them. But to a microfinance or a savings and loans down the street, 100,000 will be material. Okay, good. So we say that an item is material when its omission, obscuring, or misstatement could influence the decision taken by users of the financial statement. So we are saying that an item or a financial statement, okay, or a financial information relevance is dependent on how material it is. So we say that information is material if it omitting, misstatement, or obscuring could reasonably be expected to influence decisions of primary users based on financial statements. Okay, Good. So the relevance of an information is affected by its materiality. The relevance of an information is affected by its material. If it is material, if it is something that, if it's taken out of the financial statement, and when a user takes a decision based on that financial information, that person may suffer a loss or may have some consequence, then we say that that financial information is what? Relevant. So relevance is dependent on or is affected by the materiality of the information. Good. So we've looked at relevance. For information to be relevant, it must have predictive and confirmatory value. Okay, and the relevance of an information is affected by what? Materiality. Okay, and we've looked at what materiality is. We say an item is material when its misstatement, omission, okay, obscuring, could reasonably be expected to affect the decision taken by the primary users of the financial information. Good. Then faithful representation is the second fundamental qualitative characteristic of financial information. By faithful representation, we mean for information to be useful, it must not only represent relevant phenomena, but it must also faithfully represent the phenomena that it's purpose to represent. For financial information to faithfully represent what it's purpose to represent, it must have the following characteristics. So faithfulness or faithful representation, okay, is affected by the following characteristics. For us to be able to, or for us to say that financial information faithfully represent what it purpose to represent, one, that financial information must be complete. Now, financial information should include all the information necessary for a user to understand the phenomenon being depicted. So faithful representation is affected by the completeness of financial information. So completeness means that, for example, if I've made sales to the tune of 1 million and I made individual sales of over 500 times in a year, okay, for the financial information to faithfully represent what it purports to represent, it means that all the sales that I made during the year must be captured or must be recorded. If there is even an omission of 1 or 2 transactions, okay, the financial information will not faithfully represent what it purports to represent, because not all the transactions that occurred during the year was included in the financial statement. Okay, so for financial information to faithfully represent what it purports to represent, then the financial information needs to be what? Complete. 2, it needs to be neutral. Now, financial information should be devoid of bias in the selection or presentation of the financial information. Okay, good. So if a particular method of accounting is prescribed, you have to make sure that you have used that method. You don't go and use an unacceptable basis. Okay, so the financial information must be neutral. That is, it should be devoid of bias in the selection or presentation of financial information. So we know very well that the most acceptable basis of valuing inventory is either on FIFO basis or the weighted average. We know that LIFO is not an acceptable basis, but because you know that LIFO will project a good picture for you, then you tend to use it. No, you are not being neutral. You are being biased in your way of doing things. So neutrality looks at the financial information being devoid of bias in the selection or presentation of financial information. Great. Again, for financial information to faithfully represent what it's purposed to represent, it must be free from errors. It must be free from errors. Now, for financial information to faithfully represent what it's purposed to represent, it must be free from errors or omissions in the description of the phenomena. Okay, and the process used to produce the reported information has been selected and applied with no errors in the process. So faithful representation is affected by the completeness of information, the neutrality of information, and the information being free from what? Error. Okay, good. So let's look at the enhancing qualitative characteristics. The enhancing qualitative characteristics. One, we say that financial information must be what? Comparable. Comparability. Comparability is the qualitative characteristic that enables users to identify and understand similarities in and differences among what items. Thus, financial information of an entity is said to be useful if it can be compared with similar information about other entities and with similar information about the same entity for another period or another date. Additionally, for financial information to be comparable, there must be consistency in the use of the methods used in the preparation and presentation of the financial statement. So, for example, I cannot choose to say this year, okay, value my inventories on FIFO basis, and the next year I change to weighted average. That will not predict or show a consistent approach to the valuation of inventory. I hope it is there. So we do also say that once a method of accounting has been adopted, it should be applied from one period to another. If there is a change, then that change needs to be explained. And the purpose is for the financial statement to project what a fair view. Okay, but if there's no justifiable grounds for a change in a method of accounting, the previously used method should be applied. I hope you are together. Great. So with that is comparability. Comparability is the qualitative characteristics that enables users to identify and understand similarities in and differences among items. Thus, financial information of an entity is said to be useful if it can be compared with similar information about other entities and with similar information about the same entity for another period or another date. So when we say financial information is comparable, it means that we are able to put side by side the financial information of the entity with similar entities, okay, or the financial information of the entity with the entity's same information for another year or another date. Okay. And we are saying that for financial information to be comparable, there must be consistency in the use of the methods used in the preparation and presentation of the financial statements. All right. Verifiability is also another enhancing characteristic of financial information. So this quality helps assure users that information faithfully represents the economic phenomena it's purposed to represent. Thus, verifiability means that different knowledgeable and independent observers could reach consensus that a particular depiction is a faithful representation. Okay, verifiability means that different knowledgeable and independent observers could reach consensus that a particular depiction, okay, is a faithful representation. That is, again, quantified information need not to be a single point estimate to be verifiable. A range of possible amounts and related possibilities can also be verified. Okay, good. So by verifiability, okay, if you say that, okay, I've made a revenue of 1 million in a year, okay, do I get to see your source document? Okay, do I get to see how those transactions occurred and how that 1 million was arrived at? Okay, if an auditor should come to audit your books, would the auditor come to the same conclusion that indeed that sales of 1 million indeed occurred? Okay, it exists, it's complete. Okay, and the right cutoff has been applied in that revenue for a previous period has not been included. Okay, and that all transactions that were recorded that relate to just the accounting period under consideration. Okay, So that is verifiability. Okay, verifiability. Now, timeliness is another enhancing qualitative characteristic of financial information. Okay, what does it mean for financial statement to be timely? Now, timeliness means having financial information available to decision makers on time to be capable of influencing their decision. So, for example, if for our regulated entities in Ghana, for example, BOG regulated institutions for banks are expected to file their report by March ending of the ensuing year. Okay, SDIs by April of the ensuing year. Okay, there's the need for those timelines to be complied with, because it helps the Bank of Ghana to take very important decisions. So if the information is not made available to the central bank on time, then the kind of decision that they will take loses its value. Okay, so timeliness simply means having information available to decision makers on time to be capable of influencing their decision. Okay, good. Understandability. Now, financial information is made understandable by classifying, characterizing, and presenting it in a clear and concise manner. Okay, you shouldn't put in technical jargons, terms that a simple or a layman may not understand. It needs to be put in a clear language so that somebody without any finance or accounting background, okay, can go through and have some appreciation, not understand it entirely, but can appreciate and go through the report without any difficulty. Okay, of course, as far as it is reporting, it may include certain terms that a layman may not entirely understand, but it should have an appreciation of what he's looking at. Okay, so by understandability, we mean financial information must be classified, characterized, and presented in clear and concise manner. Okay. So these are the characteristics of a useful financial information. We know that it is twofold. We have the fundamental qualitative characteristics and the enhancing qualitative characteristics. Okay. However, in the exam, if you are asked, you can put the two together, and maybe they will not ask you to indicate the fundamental qualitative characteristics or the enhancing qualitative characteristics. So if it is just state and explain the fundamental or the qualitative characteristics of financial information, then you know that I'm going to talk about relevance, faithful representation, understandability, verifiability. Okay, then timeliness. Okay, timeliness. Okay, good. So if you are asked in exam, don't be tempted to break it down into the fundamental qualitative characteristics and the enhancing. Okay, you only do that when you can readily recall and put each. Okay, you put them, the characteristics, under each separate heading. But if you are not sure, kindly outline them as it is. Okay, state your relevance, you state your faithful representation, state comparability, state understandability, state about timeliness. Okay, good, and you are good to go. Good. Okay, so now let's talk about. Now let's talk about the cost constraints. The cost constraints. The cost constraints on useful information. Now, the benefits obtained from financial information should exceed the cost of obtaining and providing it. Information should not be provided if the cost is not worth the benefits. Since it is difficult to measure the benefit of financial information, the setters of accounting standards must use their judgments in deciding whether certain items of information should be provided in the financial statement, and if so, in how much detail. In how much detail. So, by cost constraint on information, you are saying that the benefit obtained from an information should exceed the cost of providing that information. So, basically, that is what we are looking at. That you shouldn't obtain an information which costs you more than the benefit you can derive from it. Good. Down to the elements of financial statements. The elements of financial statement. I know we spoke about this briefly in chapter 1, but now we are going to look at each single element and what it means. Good. Now, the elements of financial statement are covered under chapter 4 of the IASB conceptual framework. The IASB framework describes the 5 elements of financial statements. Okay, for reporting financial position, the elements that are used are assets, liabilities, and equity. And for reporting financial performance, we use income and expenses. So there are 5 elements of a financial statement, and they are assets, liabilities, equity, income, and expenses. We use assets, liabilities, and equity to prepare statement of financial position, and we use income and expenses to prepare statement of profit or loss and other comprehensive income, or simply put, the financial performance. Good. Now, the framework identifies 5 elements of financial statement, which are assets. Now, when we talk about an asset is an economic resource owned and controlled by an entity as a result of a past event, and from which future economic benefit will flow to the entity. So, note that you are not going to define assets as properties of a business. No, the conceptual framework, okay, the IASB conceptual framework defines an asset as an economic resource that is owned and controlled by an entity as a result of a past event, and from which future economic benefit will flow to the entity. Okay, good. So, what is this past event? For example, a company can enter into an agreement with maybe a car dealer, say company SYZ may contact Toyota Ghana, for Toyota Ghana to supply them with some cars. Okay, good. Now, when they contact Toyota Ghana, okay, to supply them with the cars, okay, good. A form of agreement, maybe to sell the car to them on maybe credits. Okay, it means that they must agree on the terms and conditions. Okay, good. Before the car will be made available to them. Okay, good. So when the agreement is reached and the car is supplied, okay, we are saying that it is a resource owned and controlled. Okay, so on delivery of the cars to the XYZ takes possession of the cars. Okay, good. So XYZ now owns and controls the car. As a result of a past event, the past event is the agreement that they went into with Toyota Ghana to supply them with the cars. So that agreement that was reached before the cars were supplied is a past event. Okay, and from which future economic benefit will flow as a result of that past agreement to how Toyota supply the car to them on credit and pay in bits. Okay, their usage of the cars, okay, will inure to the benefit of XYZ, in that it will be used, the vehicles will be used in the running of the business to generate income. Okay, so we say an asset is a resource controlled by an entity as a result of a past event, and from which future economic benefit flow to the entity. Even if you bought the vehicle outright, okay, a decision was made to buy. It's a past event because that decision to buy must take place before you possess the vehicle and make use of the vehicle. Do you get the point? Good. And as you use the vehicle, okay, you stand to benefit from the use of the vehicle. That's what I say, and from which future economic benefit will flow to the entity. Okay, good. You might have bought maybe a vehicle for maybe your CEO. Yes, it is to facilitate the CEO's movement to make sure that he's on time to get things done at the right time, among others, which will inure to the benefit of the company. So an asset is a resource owned and controlled, okay, by an entity as a result of a past event, and from which future economic benefit will flow to the entity. That is how an asset is defined by the conceptual framework. Then we have 2, liabilities. Liabilities. Now, a liability is a present obligation arising from past events, the settlement of which will result in an outflow of economic resources embodying economic benefits. Good. What do we mean? Now, assuming, let me use the example that I used earlier. XYZ contacting Toyota Ghana to supply them vehicles on credit and pay later. Now, when that agreement is reached and the car is supplied, okay, it means that XYZ is obligated to Toyota Ghana. Okay, it's obligated because they owe Toyota Ghana. Now, so we say that it's a present obligation arising from a past event. Yes, the past event here is the decision XYZ took to reach out to Toyota Ghana to go into terms with them for them to supply them vehicles and pay later. So that is the past event. That decision to go to Toyota Ghana, agree with them for them to supply the cars and they pay later, took place before the cars were given them. And as they possess the vehicle now they are obligated. They are presently obligated to Toyota Ghana as a result of that decision to go and take the vehicle and pay later. That's the past event. And now, settlement of that obligation will result, okay, in an outflow of economic resource, embodying economic benefit. Economic resource here could be in cash or a kind, an asset. So, for example, if the XYZ is paying back the money, okay, it is an economic resource. Had it not been that past obligation, or had it not been that past event, had it not been the present obligation, that cash, that money that they are using in paying Toyota Ghana could have been used for another purpose. That's why we say it results in an outflow of economic resource, embodying economic benefits. In that money could have been used for another purpose, could have been invested, could have been channeled into another business operation. Okay, good. So a liability is a present obligation arising from past events, okay, settlement of which will result in an outflow of economic resource embodying economic benefits. I hope it's understood. Great. We talk about equity interest or capital. Now, equity or capital is the residual interest in the asset of an entity after deducting all its liabilities. That is how the conceptual framework defines capital. For those of us who are a business student in SM, we say capital is the amount of money that the owners of a business start business with. Okay, great. Now, the conceptual framework defines equity or capital as the residual interest in the assets of an entity after deducting all its liabilities. Okay, good. So we know that the assets of a business, okay, you know that the assets of a business, for those of us who did business, we know that the assets of a business, okay, is equal to what? That business is what? Capital plus what? Liabilities. So we say that the equity of a business, okay, is equals to, or is the residual interest in the asset of the entity after deducting all its what? Liabilities. Okay, because on the balance sheet we have assets and have capital plus liabilities. Okay, good. So now if you want to get your capital, what you have to do is that take the total assets, okay, and less the total liabilities from it. Whatever is left represent the what? The equity. Good. Then the next element is income. Income. And income is defined as an increase in economic benefits during the accounting period in the form of inflows or enhancement of assets or decreases of liabilities that result in increases in equity other than those relating to contributions from equity participants. Income is an increase in economic benefit during the accounting period in the form of inflows or enhancement of assets or decreases of liabilities that results in increases in equity other than those relating to contributions from equity participants. Okay, what do we mean? Increases in economic benefits in the form of inflows or enhancement of assets. So for example, when I sell goods for cash and I receive cash, it's an inflow or enhancement of assets. If I sell it on credit, okay, I create debtors because the person didn't pay me, so the person owes me. That is an enhancement in assets. Okay, or decreases of liabilities. Okay, that's, for example, you are indebted to somebody and you go and pay. It means that there's a reduction in your debt. So indirectly, it is seen as an income or a gain to you. Do you get a point? Great. That results in increases in equity, because if at the end of the day your income far exceeds your expenses, the resultant figure is your net profit, and that net profit is added to your capital. Okay, other than those relating to contributions from equity participants. So contributions from equity participants may be injection of capital. When capital is injected into the business, it is not an income to the business. Do you get a point? It represents capital. Great. So an income is an increase in economic benefit during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in increases in equity other than those relating to contributions from equity participants. Now it is very simple. All that you have to do is that you read over and over it again, and it will be at your fingertips. Okay, just try and understand the definition. Don't try to chew it. Okay, good. Have an understanding so that you can even explain to someone. Okay, it's not about chewing, it's about understanding what the terminologies that have been used there means. Okay, good. And make the definition your own. Now, when you talk about an expense, expenses are decreases in economic benefits during the accounting period in the form of outflows or depletion of assets or incurrence of liabilities that result in decreases in equity, okay, other than those relating to distributions to equity participants. So an expense is a decrease in economic benefit during the accounting in the form of what? Outflows. So you have made use of, say, electricity, and you're going to pay. You part way with money. So an outflow of economic resource or depletion of assets. Now, when an asset is used, don't forget I said that assets, when they are acquired, represent a capital expenditure. And we don't want to expense everything in the period in which it's acquired. So we must spread the cost over the period that it will benefit the organization. So as the asset is being put into use, it depletes. Okay, it's wear out. Okay, so that's wear and tear. Okay, is seen as an expense. Do you get it? The depletion, when assets have been depleted, when assets have been depreciated, the depreciation is an expense. Okay, or the incurrence of liabilities. Okay, good. Now, when say you buy, for example, an asset on credit, you create a liability. Okay, now that liability indirectly at a point you have to pay, and when you pay, it's an outflow of an economic resource. Okay, and that again will lead to a decrease in equity. So, for example, if more and more expenses are incurred, when a company's expenses far outweigh the income, they make a loss, and that loss is a decrease in equity. Okay, other than those relating to distribution to equity participants, in the form of what? Dividends. Okay, when shareholders are paid dividend, okay, that dividend is not seen it's not seen as an expense. Okay, because it is treated after the statement of profit or loss or other comprehensive income. Do you get the point? Good. So an expense is a decrease in economic benefit during accounting period in the form of outflows or depletion of assets or incurrence of liabilities that result in decrease in equity other than those relating to distribution to equity participants. Okay, good. So this this is how the ISB conceptual framework defines the elements of a financial statement. So we have assets, we have liabilities, we have equity, we have income, we have expense. I believe I've been able to break the definition down to your level. Good. Again, if you have any question to ask, note them down in our interactive section. I'll take all those questions and provide you with the answers. Okay. Good. Now let's look at the recognition of elements of financial statements. Let's look at the recognition of the elements of financial statements. Now, items are recognized where they meet certain recognition criteria. However, some items failing to meet the criteria, okay, and therefore not included in the financial statements, may need to be disclosed. Items are recognized where they meet certain recognition criteria. However, some items failing to meet the criteria and therefore not included in financial statements may be disclosed. Good. So let's look at the features of recognition. Features of recognition. So that we have the general recognition criteria. By recognition, it means that bringing something into the books of a company, bringing an item or an element of the financial statement into the books, because the transactions that occur in a business are either an asset, it is either a liability, it's either an equity, it's either an income or an expense. So these are the 5 elements. So business transactions revolve around these 5 elements. Do you get the point? So how do we bring in an asset? How do we recognize a liability? How do we recognize an equity? How do we recognize an expense? How do we recognize income? Okay, there are certain preconditions that must be met before this element of financial statements are brought into the books of a company. Good. The general recognition criteria, 1, it meets one of the definition of an element of the financial statement. It means that before a transaction, an event, an economic activity is recorded in the financial statement, it must meet the definition of one of the elements of the financial statement. Okay, it must meet one of the definition of an element of the financial statement. 2, there is sufficient evidence that the change in an asset or liability inherent in the item has occurred. There is a sufficient evidence that the change is in assets or a liability inherent in the item has what occurred. And 3, the items can be measured at a monetary amount with sufficient reliability. So it means that for an item to be recognized, 1, that item must either be an asset, a liability, equity, income, or an expense. Okay, then there must be sufficient evidence that the change is in asset or a liability, okay, or that particular transaction has actually what occurred, and that we can put value to that transaction or item. Okay, so the items can be measured at monetary amount with sufficient reliability, meaning that in accounting, anything that we can't put value to cannot be recorded, because what value are you going to assign to it? Okay, great. Then let's look at the recognition process. Now, recognition is triggered where a past event indicates that there has been a measurable change in the assets or liabilities of the entity. Okay, recognition is triggered where a past event indicates that there has been a measurable change in assets or liabilities of the entity. Okay, now let's look at again the stages of recognition. The recognition of assets and liabilities falls into 3 stages. We have one, the initial recognition, subsequent remeasurement, and derecognition, that is sale or destruction of an asset. At any stage where a gain or loss results, this must be recognized either in the income statement or in the statement of changes in equity. Okay, good. So by recognition, you are looking at bringing an element of the financial statement into the books of accounts. Okay, and one, there must be sufficient evidence that that element has occurred. Okay, now again, the item should be capable of being measured reliably before. Okay, good. And we said there are stages of recognition. You have what is called the initial recognition, the subsequent remeasurement, and the derecognition. Okay, good. All right. Now, the effect of uncertainty. The effect of uncertainty. Okay. Now, where uncertainty is countered by evidence, where uncertainty is countered by evidence, the more and the evidence, the less uncertainty over an item's existence, nature, and measurement, and the more reliable the item will be. What constitutes sufficient evidence is a matter of judgment. So it means that effect of uncertainty, that is where a particular item we are not sure, okay, as to how to treat it on others. We are saying that the more the evidence, the less uncertainty over an item's existence, nature, and measurement, and the more reliable the item will be. What constitutes sufficient evidence is a matter of judgment. So the fact that there should be an objective evidence of the existence of the item, we are saying that that's sufficient evidence is a matter of judgment. Okay, great. Okay, so let's quickly look at the recognition of gains and losses. So you have looked at the general criteria. By looking at recognition, we are saying that if you are recognizing an item, the item must meet one of the definitions of the element of financial statement, and there must be sufficient evidence that that transaction has actually occurred and that it could be measured reliably. Okay, good. That is the general criteria based on which transactions will be recorded. Okay. Recognition of gains. Now, evidence is needed to ascertain if the gain has been earned. Evidence is needed to ascertain if the gain has been earned. That is, an increase in equity, interest, or net asset had occurred before the end of the reporting period. Gains reflected in the income statement are seen as particularly important since the income statement is used as a primary measure of performance. Hence, a gain included here must be earned and realized. Okay, realization is concerned with restricting recognition to those items whose existence and amount is particularly well evidenced. Okay, it's well evidenced. Okay, this will usually mean that conversion into cash and cash equivalent has occurred or is reasonably assured. If a gain fails to meet the test of being earned and realized, it may still meet the general recognition criteria. In this case, such a gain should be included in the statement of changes in equity. Example, unrealized holding gain on the revaluation of a property. Okay, when an asset is revalued, and say if its value is say 10,000 and it is revalued, book value is 10,000, it's revalued and say it is 12,000, 2,000 difference. It's an unrealized holding gain on the revaluation. Okay, it only becomes realized when the asset is disposed of. Okay, but if the asset is in continual use, we do say that that's revaluation gain, it has not been realized. Okay, good. So we are saying that for a gain to be recognized, it should be realized. It should have been earned and what? Realized. Okay, and we have also indicated that if it has not been does not meet the test of being earned and realized, it can still meet the general recognition criteria, and that we can still go ahead and not record it. But if a gain has not been earned and realized, okay, then it is treated in the statement of changes in equity. It cannot go into the statement of profit or loss. Okay, right. Then the recognition of losses. Evidence is needed to ascertain whether a decrease in equity interest on net asset had occurred before the end of the reporting period. Where a loss is not being recognized, that is, the expenditure is carried forward to the next period as an asset under the matching concept, sufficient evidence must exist. Okay, evidence is needed to ascertain whether a decrease in equity interest, net assets had occurred before the end of the reporting period. Where a loss is not to be recognized, that is, expenditure is carried forward to the next period as an asset under the matching concept, sufficient evidence must what? Exist. Okay, good. So that's how a loss will be what? Recognized. There should be an evidence that it has actually what? Occurred before the end of the reporting what? Period. Where a loss is not to be recognized, then the expenditure is carried forward to the next period as an asset under the matching concept. So in that case, we will defer that expenditure. Okay. So derecognition, as considered to some extent above, this is appropriate where a past event has eliminated a previous recognized asset or liability, or where evidence is no longer sufficiently strong to support continued recognition. Okay, good. So where we recognize an item based on certain preconditions. Okay, so if those conditions are no longer available, it means that that item must be derecognized. We say that it must meet the definition of an asset, a liability, or equity, or income, or an expense. Okay, so an item will be derecognized when it no longer meets the definition of any of the elements. Okay, good. Measurement of elements of financial statements. Measurement of elements of financial statements. Now, the framework identified 4 possible measurement bases. Okay, how do we measure? Now, to recognize, you say that bringing it into the books, but in bringing it into the books, you must be able to assign value to it. So what measurement basis are you going to use? What measurement basis are going to be used? What measurement basis are going to be used? What measurement basis are going to be used? Okay. What measurement basis are going to be used? So we have the historical costs. 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 Now, assets are recorded at the amount of cash and cash equivalent paid or the fair value of the consideration given to acquire them at the time of acquisition. Liabilities are recorded at the amount of proceeds received in exchange for the what? Obligation. So To recognize an asset, we are saying assets are recorded at the amount of cash or cash equivalent paid or the fair value of consideration given to acquire them at the time of what? Acquisition. Whereas liabilities are recorded at the amount of proceeds received in exchange for the what? The obligation. So that is the historical cost basis. Okay, the historical cost basis. Assets being recorded at the amount of cash or cash equivalent paid or the fair value of consideration given to acquire them at the time of acquisition. So if I'm buying a laptop, then the laptop is say 3,000 and I paid 3,000 for it, that is the cost. Okay. If I happen to give something in exchange, okay, then the value of that item I'm giving in exchange becomes the cost of the item. The liabilities are recorded at the amount of proceeds received in exchange for the what? The obligation. Okay, good. Then we have the current cost. Now, under the current cost basis, we say that assets are carried at the amount of cash or cash equivalents required to acquire them currently. Liabilities are carried at the discounted amount currently required to settle them. Okay, so if, for example, I owe somebody maybe 3,000, and says, okay, I'll take maybe 2,700 for it. That becomes the discounted amount. Okay, that's the current cost to me. Do you get the point? Good. Good. Then we have what is called the realizable value. The realizable value. Now, asset is carried an amount which could currently be obtained by an orderly disposal. Liabilities are carried at their settlement value. That is the amount to be paid to satisfy them in the normal course of what? Business. Okay, so for assets, under realizable, it is carried at an amount which could currently be obtained by an orderly disposal. For example, at the realizable value, we are looking at the amount you can obtain now for a particular item. Okay, that's the value you have to put for it. So even if I bought, say, my phone for say 3,500 Ghana cedis, okay, and now I can only obtain 1,200 for it. Okay, good. That becomes the realizable value. Even though it is 3,000, costs 3,000, and now I can only get 1,200 for it. I shouldn't still keep it in the books as 3,500. No. You see that it should be what? It should take the realizable value, which is 1,200, which I will get now. If it's a liability, okay, must be carried at the settled or settlement value. That's the amount to be paid to satisfy them in the normal course of business. So if I owe somebody 3,000, okay, the realizable value, if the person is not willing to give me any discount, nothing, it is the 3,000 that I owe. That's the realizable value. Do you get the point? Good. Then the present value. Now, an assets are carried at the present discounted value of future net cash inflows that the item is expected to generate in the normal course of business, and liabilities at the present discounted value of the expected outflows necessary to settle them. Okay. Now, for the issue of present value, we'll talk more about this in later discussions. Okay. Good. Where if you are looking at an asset, okay, you are saying that it will be carried at the present discounted value of the future net cash inflows. Okay, so that is the benefit that you will get from the asset. So in the use of an asset, so many benefits will accrue to the business. Okay, but the benefits will be in the future. So we need to bring all those benefits which are into the future into today's day. Okay, then we'll be able to say that, okay, this is the present value of the item. Okay, so there will be some form of discounting, okay, where we look at an interest rate or the amounts at which the firm can obtain funding from external source or from banks, among other things, and use that one as the basis to strip off the gains which are in future and bring them into present terms. Okay, Good. So we'll talk more of this as we go on. So these are the measurements, how the elements of financial statement could be what? Measured. Okay, we have the historical cost, we have the current cost, we have the realizable value, we have present what? Value. Okay. Note, although historical cost is the commonest basis, the others are often used to modify historical cost. For example, inventories are carried at the lower of its cost and net realizable value. Investment may be carried at market value. Pension liabilities are carried at their present what? Value. So this basically to explain or throw more light on the measurement basis that we have spoken about. Okay. So for us business students, we know that we learned that inventory should be valued at the lower of cost and the net realizable value. If you bought an item for 5,000 and now due to one or two conditions that are present, that item cannot be sold at the price at which you bought it. Okay, you don't keep the assets or that item in the books at the cost at which you bought it. You must keep it at the value which, if you should sell it now, the value you will obtain, that is the value you should keep in the books. Okay, good. All right, so let's now look at the regulatory framework. The regulatory framework. Now, the IFRS foundation is the structure. We have the IASB, we have IFRIC, and we have IC. Okay, good. Now, all right. So, all right. So, that's the structure of the IASB. Okay, good. So we look at that. Sorry, my mouse is misbehaving. Good. So the IFRS Foundation, formerly known as the International Accounting Standards Foundation, is the supervisory body for the IASB. The IFRS Foundation is responsible for governance issues and ensuring each body is properly funded. It has established two sub-bodies, including the International Accounting Standards Board and the IFRS Advisory Committee. Okay, good. Now, the International Accounting Standards Board, we spoke much about them. Okay, we said the International Accounting Standards Board was established in 2001 as part of the IFRS Foundation, formerly International Accounting Standards Committee. The IASB is solely responsible for issuing international financial reporting standards. Okay, the International Accounting Standards, okay, is solely responsible for issuing international financial reporting standards. So they are responsible for coming out with what? IFRSs. Okay, good. Now, what is the objective or the role of the IFRS Foundation and the IASB? What is their role? Now, one, to develop a set of global accounting standards which are of high quality, are understandable, and are enforceable. And two, to develop IAS, which requires high quality, transparent, and comparable information in financial statements to help those in the world's capital markets and other users make economic decisions. So, as we said the International Accounting Standard Board has brought the conceptual framework. They also come out with standards. Okay, the standards that they churn out must be transparent, must be comparable. Okay, to help the world capital markets and other users to make economic decisions. Again, to promote the use and rigorous application of accounting standards. And finally, to promote and facilitate the adoption of IFRS, being the standards and interpretations issued by the IASB through convergence of national accounting standards and IFRSs. Okay. The IFRS Advisory Council the IFRS Advisory Council, that is IAC. The Advisory Council, formerly known as the Standards Advisory Council, SAC, provides a forum for the IASB to consult a large range of interested parties affected by the IASB's work. The objectives and role of the IASC is one, to advise the IASB on gender decisions and priorities in the board's work, to inform the board of the views of the organization and individuals on the council on major standard setting projects, and to give any other advice to the board to trustees. Okay, so that is the IFRS Advisory Council. Okay, it provides a forum for the IASB to consult a wide range of interested parties affected by the IASB's work. Okay, good. So we have practitioners, accountants in business, accountants in practice, those involved in investment, advisory, among others. All these people have their work affected by the work that the IASB churns out, and therefore the IFRS Advisory Council advises, okay, and provides a forum for the IASB to consult people. Okay, good, right. Then we have the standard setting process. The standard setting process. Now, the overall agenda of the IASB will be set by discussion with the Standard Advisory Council. One, the IASB may establish advisory committee to give advice on issues arising from projects or gender setting. IASB develops and publishes discussion documents for public comments, that is discussion paper, and following the receipt and review of comment, the IASB will develop and publish an exposure draft. Now, following the review and receipt of comment, the IASB will issue a final IFRS. Okay, the overall agenda of the IASB will be set by discussion with the Standard Advisory Council. Okay, so one of the standard setting processes that IASB may establish an advisory committee to give advice on issues arising from projects, that is agenda setting. Then the IASB develops and publishes discussion document for public comment, that's a discussion paper. Okay, that is the process through which standards are developed. Okay, then the third is that following the receipt and review of comments, the IASB will develop and publish an exposure draft. Okay, and following the review and receipt of comments, the IASB will issue a final IFRS. Now, the need for accounting standards. Now, financial statements are used by a wide range of users, investors, lenders, customers, etc., and therefore it must be useful to all these users. Okay, it aids in comparing financial statements. Yes, because the standards, okay, are used in the treatment of financial transactions. Once a method is adopted this year to be the same, so it makes comparison easy. Okay, it also assists in the preparation of financial statement to provide at least some basic information. And it increases users' understanding of and confidence in financial statements. And finally, it regulates the behavior of companies towards their investors. Okay, good. So let's look at the final section of this section where we talk about the ethical and professional framework. Now, as accountants, as students, accountants being trained to be professional accountants, okay, there are certain ethical and professional principles that we should uphold. So we are going to run through those things. So a distinguishing mark of the accountancy profession is its acceptance of the responsibility to act in the public interest. Therefore, an accountant's responsibility is not exclusively to satisfy the needs of an individual client or employer, but is expected to act in public interest. Okay, good. Now, the fundamental ethical and professional principles that as professional accountants, student accountants, we should uphold, they are integrity, objectivity, professional competence, confidentiality, and professional what? Behavior. These are the hallmark of accountants. As accountants, you must have integrity. When you talk about integrity, it simply means that as an accountant, you should be straightforward and what? Honest in your dealings. Your A is your A, your B is B. Okay, that is, as an accountant, you must be straightforward and honest. You must have integrity. When you see B, it is your B. Okay, again, we talk about objectivity. We talk about objectivity. But objectivity, which means that you shouldn't, you shouldn't allow what bias, okay, or conflict of interest to override business what? Judgment. Okay, good. You shouldn't allow bias, conflict of interest to override business what? Judgment. Okay, good. Then we have professional competence. Professional competence. Okay, professional competence just means that if you are an accountant, okay, you must possess the right skill set to be able to provide advice or to help your client, okay, obtain professional advice from you. So that is why the ICA, we have continuous professional development, CPDs. So even though I've qualified long ago, when new standards come, I must make sure that I update myself, I upgrade myself so that I remain relevant in the business environment, so that my client will also benefit from competent professional services. So by professional competence means that at any point in time, you must stay afloat with the current happenings in the profession. Okay, good. Then we talk about confidentiality. As a professional accountant, as a student accountant, you should learn to keep your mouth mute. You shouldn't disclose information that you have obtained by virtue of your work, okay, to any other person, okay, unless required by law. Okay, maybe the company that your auditor is engaged in money laundering activities. That one is frowned upon by the laws of Ghana, so that's you are required to disclose. But the client's own information that you have become aware of because of your business relationship with the client, you shouldn't disclose it to anybody to take advantage of that information. Okay, and finally, as a professional accountant, you must act professionally. Okay, you shouldn't do anything that will bring discredit to the profession. Okay, so these are the fundamental ethical and professional principles. Okay, in our interactive session, we'll try to bring some discuss some questions that center around these ethical issues. Okay, all right. So this brings us to the end of chapter 2. Chapter 2, the IASB conceptual framework. Okay, so do enjoy your morning and have a good day.